Most people do not realize the size of our country's financial obligations. My name is Jim Kirby. I'm a certified public accountant and a certified financial planner. In this 10-minute video, I will explain why our national debt is likely to soon snowball out of control and how that will lead to very high inflation that will not be good for the stock market, the bond market, or real estate investments. I will also tell you how you can protect your money if you believe high inflation is coming. This video will present some of the facts that have convinced me that our country will soon face a financial crisis. My hope is that you use this information to protect your hard-earned assets in the coming financial crisis. This chart shows the national debt from 1942 to 2023. The data is taken from the Office of Management and Budget website. They are the official forecasting arm of the U.S. government. In December 2013, our national debt was $17.2 trillion. They estimate that our national debt will grow to $25.3 trillion by 2023. A couple of interesting inferences can be drawn from this chart. First, we are not going to cut our spending enough that it will reduce the national debt. Second, we are not going to increase taxes enough to get the debt under control. Finally, the government thinks the public will just keep buying this ever-increasing debt, which they illustrate in this chart they are not going to repay. This chart shows the interest rate on the 10-year Treasury over the last 55 years. In 1981, the interest rate peaked at 15.84%. Over the following 30 years, it was on a downward trend, and it hit a 200-year low on June 1st, 2012, when it got down to 1.44%. Then, by the end of 2013, it had more than doubled to 3.04%. One of the key takeaways of this chart is that the average interest rate over this 55-year period was 6.36%. The first two columns of this graph show the 2013 budget of the U.S. government in percentage terms, with revenues being 100%. The two columns on the right show what the 2013 budget would have looked like if the interest rate, instead of being 1.8%, returned to the 55-year average of 6.3%. In 2013, entitlements were 72% of revenues. Entitlements are things like Social Security, Medicare, and federal pensions, things that are required to be paid out by law. Interest expense was 8% of revenues. Defense spending was 27%, and non-defense spending was 16%. We borrowed 23% because we didn't have enough revenues to cover our expenses. In 2013, interest was $223 billion on net debt of $12.4 trillion. That worked out to be 1.8% average interest. Shifting to the two columns on the right, if interest in 2013 would have been 6.3%, the 55-year average, that would have cost the government $781 billion last year. That is $558 billion higher than the $223 billion we paid out. If we had a problem raising the $85 billion per year that sequestration required, how could we pay an additional $558 billion? We couldn't. So if the interest would have been 6.3% in 2013, our entitlements still would have been 72% of revenues, but the interest would have increased to 28% of revenues. At that point, 100% of our revenues would have been consumed by entitlements and interest. We would have to borrow 43% to cover defense and non-defense spending. Can you imagine what would happen if interest rates returned to the 1981 level of 15.8%? At that point, interest on the debt would be almost $2 trillion per year. It is easy to see how the debt could snowball out of control as predicted in the book Aftershock, second edition. Believe it or not, the national debt is not the 800-pound gorilla in the room. The 800-pound gorilla in the room is the entitlements. The present value of the entitlements is $60 trillion. If you add the national debt to the entitlements, our obligations total $77 trillion. USDebtClock.org is an interesting website. If you go to this website, which I did on January 9, it will show you the national debt. It says it is $17.3 trillion. Then at the bottom, it shows you the unfunded liabilities. These unfunded liabilities are the entitlements I've been talking about. The total unfunded liabilities are $127 trillion. That $127 trillion of future payments discounts to the $60 trillion present value shown on the previous slide. I was surprised to find out that Social Security is only 13% of the unfunded liabilities. The prescription drug program is 17% of the unfunded liabilities and is greater than the liability for Social Security. That surprised me quite a bit. But it just blew me away to find out that Medicare is 70% of the unfunded liabilities. If Medicare is 70% of the $60 trillion entitlement liabilities, that means Medicare is a $42 trillion liability, which is 2.5 times our $17 trillion national debt. David Wiedemer, who has a PhD in economics, Robert Wiedemer, and Cindy Spitzer were some of the few who saw the 2008 collapse in the real estate market coming. In 2004, 4 years before the collapse, they began writing a book, America's Bubble Economy, which was published in 2006. That book predicted the collapse of the real estate market and the stock market. In 2011, they published Aftershock, second edition. In Aftershock, second edition, they predict that in the next few years, the government will no longer be able to refinance its debt. Its first action will be to make up the difference between spending and the tax revenues it takes in by massively increasing the money supply and creating multi-100% annual inflation. This cartoon shows lemmings going over a cliff. One of the little lemmings approaching the cliff says, "Wait a minute, something feels wrong." Ask yourself, at what point will something feel wrong to you? If something feels wrong to you now, call us at 714-203-8900 to schedule a free meeting to talk about how to protect your hard-earned, hard-saved money. There is no charge and there is no obligation. You may also want to visit our website to view other presentations on our overpriced stock market and on how the Fed's quantitative easing may affect your hard-earned assets and financial security. Now for the disclosures. This seminar discusses some of the long-term consequences our country may face if we experience very high inflation. It contains forward-looking statements. It's never possible, however, for anyone to predict the future of the economy. Nevertheless, inflation and other dangers discussed in the seminar are legitimate concerns. This seminar is intended for educational purposes only. The opinions included do not constitute investment advice or a recommendation to buy or sell a security, and past performance is not a guarantee of future results.